All right, fools. It is almost 2:00 Eastern and it's a Tuesday. So that means it's time for the Millionacres Hour, where I get to chat about my favorite topic, real estate, with some of our investors and writers and analysts. And I'm here with Matt DiLallo. And one of the things that's interesting is today we were planning ahead of time to talk about big deals, investments, mergers and acquisitions. And then poof, we got breaking news this morning about exactly that. So it's kind of great timing. Hey, Matt.
Hey, how you doing? I love mergers and acquisitions. So this is one of my favorite topics. I'm really excited about this show.
Awesome. Because I mean, I don't know about you, but I just feel like I'm seeing like takeover, merger, joint venture, boom, 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 one on top of each other, especially the last 3 months. And, last year was kind of quiet.
Yeah, as a writer that focuses on this, it's been great for me. I just had so much content just kind of thrown at me. There's just so much money that's out there by, institutional investors, and they just have so much capital. And then you throw in low interest rates, and it's just a perfect storm for this type of M&A activity.
Well, yeah. And you mentioned big money. Practically every deal we're not talking millions anymore. We seem to be talking billions or very close to it when we're seeing these types of transactions. And it's one of the things I want to talk about sort of as we start is last year, we started hearing about all of these capital funds kind of amassing, and then there was kind of nothing and they didn't really do anything. And then now we've seen all of this activity. I think some of that is just pent up demand, but why else is this happening?
Well, a lot of what happened last year is companies didn't know what the price of things were, and that's what drives M&A activity. They need to have buyers and sellers agreeing. And so with so much dislocation in the market, sellers, thought that something should go for one price, and buyers were obviously looking for bargains. And now that more deals have kind of come through the pipeline, they have a firm idea of what values are in the marketplace. And that's just making it easier to do more deals because you can benchmark it against this other deal and, okay, this is a good price and let's sign on the dotted line. And it's really helped them just unleash this floodgate of deals.
Well, I think you're right about price. I think one of the things that happened is that, at least for the first part of last year, a lot of people were anticipating a dramatic drop in commercial real estate prices. And so there was a lot of waiting on the sidelines, waiting for that moment when things were going to drop. There were going to be loans in default. There was going to be an opportunity to strike. It never came along. And so I think some of this too is just capital realizing like, we're waiting for something that may or may not ever happen.
Yeah, and you even see that in the residential housing market. I know personally, I was looking to buy a second home last year, and I was waiting for prices to drop. I thought, oh, this is going to be a great opportunity to buy a vacation home as an investment, and prices just kept going up, and that just fed the market more and more. And we saw that in the commercial side. It was just the Federal Reserve and bankers, they just threw so much money at the problem, which it's never happened before. Last time they usually let the market correct, and when they didn't let the market correct, everybody's like, oh, okay, this is not going to collapse. I'm not going to get these great deals, and it was just a surprise because this is not how it usually happens.
Let's talk about this breaking news that came out this morning. So Columbia Property Trust is being taken private by PIMCO. Did you have any idea this was going to be happening? Has Columbia Property Trust been looking for a deal like this?
Yeah, so this all started back in, I think it was March. They got approached by one of their investors and wanted to take them private. They sent a non-binding offer. Hey, we'll buy you at $19.50 a share. That kind of jump-started this process where Columbia and its board went out and they solicited bids for the company. They had over 90 companies that they reached out to as far as like trying to did they want to do mergers or acquisition or joint ventures, or how they wanted to kind of maximize the value here. And they ended up getting a bid really right at what the other investor went at. It's $19.30 a share plus a dividend, which is $19.51, so a little bit more than that. All cash deal, so that locks in a good return for their investors. It's a 20% premium to what it was trading back in March. So that's pretty significant for how office properties they haven't picked up as much as others, but there's still, a lot of interest out there in office properties. Columbia itself, it owns office properties in gateway cities. So New York, San Francisco, Washington, Boston, these big markets that we really haven't seen the return to the office yet. So this is really a bet by PIMCO that we are going to see a return to the office eventually. Companies are going to use offices in the future, maybe not exactly the same way as they have in the past, but they're still going to be valuable. Maybe they'd be hybrid workforces or something like that, but they really believe, and to put this much money behind it, that offices are very valuable in the future. They're going to play an important role.
Well, I think it's kind of a positive sign that many different potential suitors were interested in Columbia Property Trust. When you consider that it's office properties, it's in cities like New York and San Francisco that have, suffered during the pandemic, Delta variant factors where return to office keeps getting pushed back now into next year for a lot of companies. So this deal comes at a time, some of the other deals we've seen are in sectors that are really hot. Office properties in the major gateway cities, not exactly the hottest commodity right now.
It's interesting, though, is who really likes these properties. You see a lot of the REITs that own them, and a lot of people that own REITs are retail investors like myself. But who really wants these properties are these institutional investors like pension funds. They really see it as a good place to get yield in a low yield environment. A lot of offices have 10 plus year leases. So there's a lot of certainty that cash flow. So they look at it kind of like a bond. And PIMCO is a prime example that was their history. It was bonds. And so it's these investors looking for that yield, looking for that cash flow, and offices can offer that. It's not going to offer the upside of your industrial properties, but institutional investors, a lot of times they need that cash flow to pay pensions for teachers or other retirees. So this is a way of doing that that's not bond related.
So if you're a shareholder in this company, is this subject to a vote, or is this already a done deal?
I'm pretty sure it's subject to a vote. I wouldn't be surprised if this is a done deal, even though there were so many others that were interested in it. They had a robust process. We really won't know until a couple of weeks, and the reason I'm coaching this answer is because we're going to get to a deal that I thought was a done deal that turned out not to be a done deal.
Right? Exactly.
Process. So you really don't know. It seems pretty certain, though. They had a robust process, and this was an all cash one, and the one that we're going to talk about that fell apart was a stock one. And it seems like these type of investors wanted to just cash out and put their money elsewhere. So I'm thinking it's a done deal, but we never know.
If you're an investor in this company, how should you feel about it? Should you take your money and put it into another REIT that you like? What's sort of the experience on the investor side? Yeah,
I think if you're a Columbia property investor, you've lucked out in a sense because they've really outperformed other office REITs it's definitely since this deal came out. Personally, I think offices are an attractive investment because nobody wants to buy them. So if I was me, I would be looking at, for example, Boston properties, almost a similar portfolio as far as geographies, gateway cities, and they have a lot of partnerships with some really deep-pocketed investors, and they're going out buying properties. They just bought some in Seattle, which is a new market for them. So that would be a good place to put your money to work.
Yeah, I agree. They're also looking to expand their life science portfolio, which I like. The other two that immediately came to mind for me are SL Green. I think that's been doing pretty well and betting on that New York rebound, and also Alexandria Real Estate, which I know is getting a little bit pricey, but in terms of what it's doing as far as life sciences, it's a pretty exciting company.
Yeah, I also like Cousins Properties, which is Sunbelt focused. Austin's a big market for them, Atlanta, and that's where the offices are growing. And so many companies are relocating and expanding theirs, and so they're leaving a lot of these gateway cities. But the other thing is there's an upgrade factor where if you own Class A offices, companies will tend to move up to that spaces. So these type of offices will be in demand. They might struggle, a little bit and not see the rental growth rates, but they're going to be in demand, and it's going to come at the expense of a Class B or Class C office space.
Right. We've got a question on the ticker. It's CXP, right? Columbia
Yeah.
Property Trust?
Yep.
Yeah.
Hmm.
Okay,
Yep.
great. All right. So this one, so that'll probably close out. I believe it's end of the year, right? We'll probably know by the end of the year if that one, when
Yeah, I think so.
transacts. All right. Are you ready to talk about the one that we actually were supposed to start with today?
Yeah, this is a fun one for me because I'm actually a shareholder in this one.
Well, you were kind of, I've been working with you on this because I've like watched like each aspect of it. I think you wrote a different article on, because this has been a soap opera. You've got these two titans, right? You've got Sam Zell and Barry Sternlicht of Starwood, and they're fighting over Monmouth Real Estate. So that's ticker MNR. Is that correct? No.
Yes.
Yes.
Mhm.
Okay, good. So why were these two giants in real estate fighting over this company?
So this was an interesting deal from the start because Equity Commonwealth, which is Sam Zell's controlled company, is an office REIT. They have now 4 properties. When Sam Zell and his team took it over, it was one of the biggest office REITs at the time. They steadily sold it off, positioning it to take advantage of opportunity. They never saw an opportunity they liked in the office space, and so they decided to pivot to industrial real estate. And they saw Monmouth as a great target. It owns high quality industrial properties, your warehouses, logistics type stuff. The biggest tenant is actually FedEx at more than 50% of the rent. So it's really a FedEx based company. They're one of, they really help FedEx with their logistics real estate. So they saw as a great cash flowing business that they could use as the platform to expand into industrial real estate. But a lot of other people wanted it, including Starwood Capital. They were one of the last bidders, and it was really down to those two. Equity Commonwealth offered all stock, even though they could have paid cash because Sam Zell's company has like $3 billion in cash, but they went with stock because they wanted to use this as a platform to expand, and they wanted that cash to be able to do other deals. Starwood offered all cash. And in this case, after a lot of back and forth, it looks like shareholders wanted that certainty of cash versus the upside of the equity they would have gotten. So I was surprised. I thought that this was going to go Sam Zell's way. I'm disappointed, but kudos to Starwood. They won.
Why was it being offered in the first place? Was it just looking to transition, or what was happening there?
So they had some of their institutional investors wanted to acquire them. They wanted to take it private. And so they offered, a deal, and that sparked, similar to Columbia, where it sparked one of these let's go and see what we're worth type of things. And they went out and they did a complete process, and Zell's company and Starwood were the last men standing in this case after a bit of a bidding war. And it's still not a done deal. Like, they haven't agreed to a deal with Starwood, and the initial private equity companies or hedge funds, I'm not sure exactly what they were. The investors that kicked this off said, "Hey, we're still interested if this falls through." So it looks like somebody's going to buy them, but this was what was kind of driving it. They wanted to take it private.
So it's not a done deal for Starwood. So does that open it up for everybody else? Are we going to see another round of potential deals before this actually ends up going private? Is there any sort of deadline for the company to find the right suitor?
I don't think there's a deadline anymore because equity bowed out. They terminated their agreement, and they're going to get a termination fee, and that was
Right.
part of what was the negotiating. Starwood offered a higher value, but they netted out the termination fee. So now they're free to do whatever they want. I don't think Zell is going to get back in it if this falls through, but industrial real estate is so hot right now. It wouldn't surprise me if somebody else comes to the last minute and says, "Hey, we've got cash. Let's go take a run at this one."
Well, it's interesting too, because you've really got a situation where we can't build industrial real estate fast enough in the areas that we need to have it. And so that's one of the things that keeps driving the prices up. And industrial, traditionally not the highest priced sector of real estate by any stretch, relatively small price per square foot, but that keeps going up. The valuations keep going up. Is it a little bit bubbly? Is there any concern about that? Or is it just that we need so much of it that it's probably not a concern even as prices spike?
Yeah, I'm not concerned at all. I think it's got so much room to run. And one of the things that really, as I dug into the sector, Prologis, which is the behemoth in the sector,
Yes.
They had a white paper that they put out, which went through all the reasons why there's just the capacity. It's going to be constrained to building. There just isn't the right real estate available, number one, that's suitable for this, because it really has to be located. It's all obviously real estate, location, location, location. They need specific types of locations to meet these properties, especially your last mile distribution centers. They need to be right in the right spot inside, metro areas. So they're running out of prime real estate to do this. And there really isn't places you can convert. There's been talks of maybe we can turn some of these shopping centers into industrial real estate, and Prologis said even if you did that, that's only 3% of what they use in a year. And then there's this not in my backyard. You have permitting issues, so they're really running up. Yeah, they're really running up into a brick wall of where they can put this. So that's one issue, and what your Amazons and your FedExes want in a property is really high quality properties, and so it costs more to build them, and costs are going up. We've seen a lot of inflation, labor costs, so it's getting really tough. And that was one of the reasons Sam Zell wanted to buy a platform as opposed to build out his own, because you need that platform to kind of kick off. And so I'm bullish on this sector just because it's going to be really hard to build out all the capacity, hundreds of millions of square feet. I think it was like 330 million square feet by 2025. And to put that in perspective, Prologis, I think, probably owns that alone in the United States. I know they're like $1 billion worldwide, but you need to replicate a huge company like that to meet that, and it's just going to be really hard to do.
Well, let's talk about what this means for Sam Zell and Equity Commonwealth, EQC, because they're trying to pivot. He's got $3 billion in cash. Obviously, this deal would have been a nice, perfect little pivot. You turn a stock that's not doing so great lately and people aren't really excited about into something that suddenly a lot of people are excited about and see as forward-looking versus backward-looking. If you're Sam Zell, what do you do now?
Well, it's interesting. I scanned through their conference call second quarter to see if there was any tidbits, and this was when the deal was still going on. But their CEO said that they're already looking at other M&A transactions. They're looking at portfolios, and they're also looking at ground-up development. And they were even looking at taking Monmouth in a different direction. So what Monmouth does is they own single tenant net lease industrial real estate. So FedEx is the only tenant. They were looking at, we could do multi-tenant things, and also Monmouth only buys existing properties. So they have relationships with developers, and developer will finish it, lease it out, and then they'll buy it. They were looking to, the higher risk development, because that's where the returns are. So I would be surprised if they don't continue in that direction and maybe go for another target, maybe buy it from, a private equity fund that has a portfolio they want to cash in. Because a lot of times private equity funds, they only, that's like 5 to 7 years, and then they have to cash out. This is a great time to cash out. So that's an opportunity. There's some other smaller publicly traded REITs they could look at. So I'm pretty sure they're going to go that direction. They seem pretty bullish on the sector.
Well, that makes sense. Definitely, it seems like they're probably going to look for things. But the question is, though, in terms of building, that will cost more money and more time. And so is that something that the shareholders and investors should be concerned about if they're trying to do building directly versus just trying to acquire? Like, if you were a stockholder of that company, how concerned would you be about where they're positioning themselves?
Yeah, and as a shareholder, and I can actually really speak to that one. I see them as like a SPAC right now on industrial real estate, because we know that's the direction that they're going. Maybe they decide, let's just fold up and we'll return all the cash to shareholders. But Zell's such a smart person. He knows, what he wants to do. So the development side, as a shareholder, I would be a little leery about, because they have so much cash. You can't put $3 billion to work realistically in a short amount of time to give investors a reason to hold on. So I really think they need to buy a portfolio and get that platform set up, and to prove to investors that they have cash flow coming in, because REITs, investors want those dividends. equity hasn't paid what in years other than doing some special dividends. And that would really draw more investors to the company and build up that equity value. And I think that's one of the reasons why the deal fell through. Their share price went down after announcing the deal. Investors, I just don't think they gave investors enough reason to own it and to buy it and to be behind the vision. So if they can get that vision out there a little bit more with some visible deals that they have in the pipeline, that might help.
And so on the Monmouth side, what happens with how the stock reacts? Because right now it seems like there hasn't been a massive, it looks like it went down a little bit immediately after the deal, after the shareholders voted against the deal. Now it seems to be sort of trending back up a little bit. What do you think the long-term ideas for investors, knowing that there isn't necessarily that much of a long term, but what do you think is going to happen in the next few months as this sort of soap opera keeps going?
Yeah, I would assume that sooner rather than later, they'll strike some sort of deal with Starwood. Other than I don't really think they want to go through that whole process again. And it seemed like the vote was not only a vote against the equity deal and the upside of what Sam's company was offering, but they wanted that certainty of cash right now. So I would assume that they're going to accept that deal and that will go through. But it's been such an interesting ride. Who knows who's going to come in at the last minute and give me more to write about.
So if you were an investor, would you buy it right now thinking that maybe it's going to have a brief spike, or would you not buy it right now because you're traditionally a buy and hold investor and this really kind of has an end date ahead of it?
Yeah, if you bought now, you're really speculating that somebody else is going to come in above Starwood and that there's going to be a bidding war with, like an all cash bidding war with Starwood. It's possible. And that's probably why the stocks reacted the way it was. But, I'm more of a certainty type of guy. And so I wouldn't want to buy now. I would look for value elsewhere.
So you said you're a shareholder. If this deal goes through, you get your money back. We talked about what you would do with the other one, with Cousins Properties. What would you do with that money for this one if you're looking to put it somewhere else in the industrial space?
Yeah, so if I was a Monmouth shareholder, like we've talked about, that there's so much froth in the market. Most of the REITs, your Prologis and those types are trading at 20 to 30 times FFO, which is a metric that we use to measure REITs. For example, office properties trade at less than 10 times. So you're paying up for that. But there's one that I like as far as like a cheaper one. It's Stag Industrial. They're not only the warehouses, they also own like your traditional industrial properties, like a manufacturing place or a flex property, which might have some office space and some other type of warehouses. They're probably they're under 20 times, I think, the last time I looked. So that's a cheaper way to play. They pay a monthly dividend. It's higher yielding than you'd get. So that's where I would put my money to work.
Let's talk about some of the other industrial real estate deals that we're seeing, because there've been a couple of, we talked before about billion-dollar deals. Recently, an Abu Dhabi-based Mubadala investment they just announced, it was last week, that they're partnering with Crow Holdings to develop $1 billion of Class A industrial across the country. Now, we talked before about some of the issues that are facing like construction in general. First of all, there's always labor issues. We had them before the pandemic for years. We're going to continue to have them. The other thing that I'm seeing too is the price of steel. We spent so much time the first half of this year talking about lumber and freaking out about lumber. Meanwhile, steel has been kind of steadily ticking up, and I know that's becoming more of a concern as well.
Yeah, it's just going to be so much more expensive to build these properties, but that really benefits the people that already own it. I know Prologis is really excited about this because they've seen just the value of older properties go up, because you talk about replacement costs or replacement costs. And this was probably as of the first quarter, and I'm going from memory, but I think replacement costs were up 25% year over year. And a lot of that was seal real estate value. So rental rates have to go up to justify this. And that's just going to benefit any properties that they own that has, maybe there's a year or two left in the contract. Well, the rates are going up significantly when those contracts expire.
Let's talk about another one, AIG Global Real Estate and LB Asset Management. They're also another billion, but they're investing in an existing portfolio, which is 8.6 million square feet of industrial, and this is on the behalf of Korean institutional investors. And so that makes me think, we've got an Abu Dhabi deal, we've got a Korean deal here. In the past, we saw a lot of foreign investment in office space. I wouldn't say that we saw as much foreign investment in industrial, partly because it was industrial. It wasn't, not exactly the sexiest sector out there. It seems to me like maybe we are seeing a lot more of, international investment in industrial just because we've got a sector that is, growing, prices are ticking up, and demand just seems kind of limitless.
Yeah, and that, money always chases money. And so they think they can make more money on this because the pandemic was really a tailwind for this, because not only did it accelerate e-commerce, but so many companies got caught flat-footed with inventory issues. And, we had all these supply chain disruptions. So instead of the whole practice of just-in-time inventory where we just have enough for what we need, we've realized we really need some of that in stock. And so there's just those two big demand drivers of needing industrial properties. So, and outside investors see this, they see this as an opportunity to not only get the yield, but the growth that you don't typically see in real estate. So it's a really big draw.
And I think it's also a sign of increasing sophistication in foreign real estate investment in general. In the beginning, when foreign investors are discovering something, maybe they'll tend to go for like trophy properties in gateway cities, the things that kind of have that like cachet. Now it seems like there's a deeper level of understanding of markets, certainly of secondary markets in general. I mean, one of the things I think that's interesting about chasing that sort of evolution of foreign real estate investing is that it's gone from Miami, New York, San Francisco, and now going into those secondary cities, seeing more foreign investment in Nashville and Charlotte and some of the cities that are also experiencing so much growth right now.
Yeah, it's really, you have to look at these two markets completely different. So office, traditionally Class A gateway cities, that's what you want to own. But industrial is just such a different market because it's really about where people are, and people are out in the suburbs. People are in these, other second tier cities where that's where the growth are. It's cheaper and that's where people want to be. And so that's really been a huge growth. And Class B real estate is also doing very well versus Class A. You won't have if somebody's renting Class B industrial property, they don't really care to move up to Class A. They don't need the fancy showrooms and all the bells and whistles. They just need a place to store their stuff. So both sets are doing very well, and you can get great returns either way.
Well, let's also talk about Canada, because we've got two interesting deals, sort of Canadian related deals. First one is with BREIT, Blackstone's REIT. They agreed to acquire WPT Industrial Real Estate Investment Trust. It's a $3.1 billion deal. And that's a Canadian REIT, but it also has a logistics portfolio. And tell us about that one.
Yeah, so one of the things I really like to do as investors to watch what the big names are doing. So we talked about Sam Zell. Well, Blackstone is another just huge name in real estate. So I really like to see what they're doing. And they have a non-traded REIT. So you can't buy it in the public markets. You have to buy it through a financial advisor, but it's huge, $50 billion in assets. So they've really been focusing on industrial real estate and multifamily properties in the Sun Belt region. So two of my favorite trends. So I really like watching them, and $3.1 billion to buy this Canadian REIT, but its entire portfolio is U.S. logistics properties, and they paid a really big price. It was 19.5% share price premium, but then the net asset value of that portfolio, 32.1% premium to what the portfolio is worth. And that just shows how much growth they see is embedded in just the value of that real estate. They think it's going to go up as contracts expire and then they release it at higher prices. To pay that much of a premium, they just see a lot of upside. So I just thought it was a really interesting deal. They're a very sophisticated investor, and for them to pay up that much, that just shows you how much upside they still see.
Yeah, that one really fascinates me. I certainly agree with following Blackstone as a great way to understand real estate. They're doing so many things, data centers, single family rentals, like all of the trends that we're interested in. Blackstone is always the one to watch. But yeah, that NAV, that premium, that is really high. That is a really strong bet that they think that they're going to get their money back. I would assume relatively quickly, but that seems to indicate that there's a lot more room for prices in industrial to grow.
Yeah, I think that's really what this is saying is that, and it goes back to what we were talking about earlier, development. There, you can't really develop as much of this real estate as we think we need, and so that just makes what's already existing so much more valuable. And so even though on paper it was worth one amount, as they're looking forward, they see it worth so much more as really the contracts, change hands and they get a higher rental rate and just the cash flow on these properties goes up. And that's what this particular REIT that they formed is all about. It's a cash flow REIT. It's not like they're focused on growth, but they really are thematic investors. And so they see industrial real estate as being this great theme to generate steadily rising income. And that's what they're gearing for. They see this is an opportunity to fulfill that mission of steadily rising income for their shareholders.
Well, the other thing I wanted to clarify too is the difference between like industrial versus logistics, because logistics to me seems like it is a subsector of industrial, because there's also, as you mentioned earlier with Stag, there's manufacturing and things like that. And manufacturing is growing too. Certainly we're seeing more onshoring. We're seeing, the need for that as our ports are so jammed up. But logistics in particular as a subset is just going through the roof because of the e-commerce trend.
Yeah, and a lot of times when we talk industrial, we really mean logistics properties because that's where a lot of the growth is. Now, there's, as you mentioned, there's a lot of other good spots in industrial real estate, but we just need so much warehouse space. A lot of what the other properties will benefit. For example, Stag owns, let's say they'll own a manufacturing facility. It's going to have like a 25-year lease, so it's a cash flow property. But these industrial, these warehouse focused, yeah, they'll maybe have a 5 to 10-year lease, and you're looking at as that lease rolls over, that's much more cash flow in the bank. That's what they see is they can really release these at much higher rates.
Yeah, and one of the things I've been covering recently is this idea of the big fish versus the little fish in industrial, because you've got your Amazons and your Walmarts and your Targets taking up so much space, and then there's not enough room for the little fish. You mentioned earlier the single tenant warehouses. It really seems like one of the things I find interesting is that like Amazon and others, they're doing a mix of buying their own fulfillment facilities, but they're also leasing an awful lot all over the place.
Yeah, Amazon is just a beast out there for every type of real estate. But yeah, if you look at a lot of these REITs, their top tenant is going to be Amazon, and it's the top by a lot. Like it'll be 15%, and the next biggest one might be 5%. So they're just such a behemoth in this sector, and they're one of the big drivers of a lot of this growth.
That's true. Well, let's talk about one more Canadian one. KKR selling around a third of its logistics portfolio to Oxford Property Group for $2.2 billion. And Oxford is part of the Canadian pension fund, the Ontario Municipal Employment Retirement System. Certainly, we've seen that in the U.S. too. The pension funds are doing a lot of investing in real estate, and it seems now in industrial real estate in particular.
Yeah, and it's all about the same themes. They just see this as a great opportunity to, in this case, grow the income that they're producing that will help pay these teachers, in this case, municipal workers, the teachers unions. They have in Canada that they're very big investors in as well. I thought this was an interesting deal because KKR is kind of a new kid on the block in real estate. They don't have like the name brand that Blackstone does, but they basically they did 50 deals to build this portfolio, built, a lot of small deals. And then that, made it a much more valuable portfolio by having us building a large scale portfolio. And so they're basically are flipping it now. I think they've only been in this business like 4 years, and so they're flipping like a portion of their business. It was a really savvy deal. They're capturing this demand from these sophisticated investors, and a smart one for them.
And so what do they do next with that money then? Do you think they're going to be in the business of acquiring more industrial, or are they using that money to do something else?
Yeah, I don't know specifically. A lot of times these funds, they have to return money to their shareholders every once in a while. But I know KKR is really building out the real estate brand. They're actually just started a net lease business. And so net lease is where the tenant pays basically everything. And so it's very steady cash flow. And it's attracting people that are looking for yield. So I think they're going to build out like a $3 billion portfolio. They grabbed a couple of people from W.P. Carey, which is one of the leaders in this space, and they want to build out this net lease portfolio. And they got a lot of money to do that with. And they're still buying logistics properties. I saw, in the same time they're selling this, they bought a couple more stuff recently. So they're really getting into real estate over there.
Interesting. So then they can use this money to buy some more real estate, and then they could perhaps flip that again and just kind of keep stacking up the cash. That's kind of a great strategy right there.
Yeah, and that's where a lot of these more sophisticated investors, what they'll do, they are buy and hold, but they're not a buy and hold forever. So they'll buy it 4, 5, 10 years maybe, but there's always a sale in mind, because that one gives their investors a return. They can return capital to investors that want to cash out, but it also just showcases their ability to create value. Once they sell, that's when they can say to their investors, hey, we did this IRR that was really great, and it's almost like a sales piece to show how good they are.
Well, yeah, definitely. And so let's talk about more things with Sam Zell. So one of his other REITs, Equity Residential, is going into a joint venture with Toll Brothers. Toll Brothers is, of course, the luxury home builders, sort of the top tier of the home builders in terms of price per home. They're going to invest $750 million in a joint venture over the next 3 years, and Equity Residential, ticker EQR, is contributing 3/4 of it. And they're building these communities in really the cities that are some of the cities that are the hot ones that we've talked about, Austin, Texas, Atlanta, Dallas, Denver, San Diego. So it's an interesting deal, because Toll Brothers, I think, is just starting to figure out, and I'm seeing this across some of the other home builders too, they're starting to figure out multifamily, and they're starting to figure out build to rent at the same time too.
Yeah, it's always interesting to watch what people that really know what they're doing in this business when they do these type of deals, and we as real estate investors can get ideas of what the trends are. And so one of the really interesting trends, and we're going to talk about this a little bit later, but you see home builders are really partnering with investors in these build to rent programs. Now, in this case, they're building apartment buildings for an apartment building owner, and it just gives them this clarity of sales. Instead of what they would do, they would build this apartment building, then try to rent it up and then sell it to an investor. But this just makes it easy. They know who's going to buy it. The deal's already done, and in the same side, it gives Equity Residential this visible growth. They can use their balance sheet to help fund these apartments. It's not going to really impact their metrics because it's in a joint venture, and they get this visible growth with a company that really knows how to build apartments. So it's a really great strategic partnership, and there's several of these that are coming up where you see smart people on both sides partnering together, taking advantage of the trend. In this case, the trend is we need affordable housing, but this is affordable housing to higher net or higher earning people, but they still need apartments that suit their needs in these fast growing markets. So it's an interesting combination here.
Well, I've also been watching it too, because we talked the home builder earnings last quarter, huge. Last couple of quarters have just been phenomenal. The home builders can't build houses fast enough, but they're also, you've got very savvy long-term thinkers at all of those companies. They know that they're dealing with a trend that will end. We've already seen new home sales kind of tick down a little bit. So I think it's interesting that they're finding these other ways to build and to make money. You haven't really seen that from some of the home builders before, but I think they are probably more forward thinking than I've seen them be before.
Yeah, because home building is a very cyclical industry,
Right.
and they know that there's a bust coming. It just always happens. They don't know when it's going to happen. So if you can have deals in the pipeline that just can give you some sort of cushion, and this also cushions against inflation because they have the pricings in there for both sides. They know what they're going to pay, and it just really helps to create a more stable earnings profile for these home builders for at least a portion of their earnings, and that could give investors more confidence, and they can get a higher multiple in the future. Than a lot of times investors are kind of scared of home builders because of the lumpiness. But if there's some consistency, that'll really help.
Exactly. Yeah, I think that's exactly where they're going. Let's talk about another sector that I find really surprising that is coming back so fast. We just had a story on the Millionacres site. I think it was today or yesterday about student housing. There's actually kind of a scramble for student housing right now. It's really interesting because it's obviously was affected a lot by the pandemic. We're still having different schools thinking about their policy with the Delta variant and masking and all of that. But student housing is back really strong. You and I have both talked about American campus communities before. They just had a strong quarter. And then there are now these other deals that are coming along where a couple of companies are doing some big things with student housing. One of them, I know one of your faves, Brookfield, which I feel Brookfield's a little like Blackstone for me. It's like, see what they're doing and kind of follow along.
Yeah, they're so smart. They're very forward thinking, and student housing is one that I really thought was going to do poorly in the pandemic, and it held up much better than I thought. And I think part of it is because students actually didn't go home. A lot of times they stayed on campus. They just wanted to be near their friends or whatever, and that surprised me. I thought they would empty out, and this is going to be really hard hit, but it hasn't. And now. You see all these really smart investors that are putting big dollars in Brookfield, Blackstone, and it's because if there's a lot of growth coming, there's a lot of younger millennials that are graduating high school in the next couple of years. My niece graduates this year, and they're going to be looking for places to stay, and a lot of these big schools just don't have the room on campus, and so they need these student housing providers to help them. And I think it was American Campus Community said that there's like a 20% decline in just the supply in some of their markets, and that's going to just make rental rates go up. And so they're really well positioned for that. And you see Brookfield trying to get into it in Blackstone because they see a lot of growth ahead.
So Brookfield's doing this deal with Scion Group. They're going to acquire about another $1 billion of student housing. Scion is interesting because they have an existing portfolio of 58,000 beds in student housing. You always talk about the beds versus the units or anything like that. So they've got 58,700 beds in 29 states. And the other thing that's interesting is Brookfield is already in this business, but not in the US, because they acquired Student Roost in 2016, and that one's based in the UK. And so they've got properties now throughout Europe, 159 student housing properties, but they haven't done that in the US before.
Yeah, and it's a logical kind of extension of this business. The U.S. student housing market is very robust, and it's mostly private equity owned because American Campus Community is pretty much the only public company that owns these. So
right.
You see all these smart investors that own these properties, these institutions, because it's a really steady business, and they like that steadiness. When you're dealing with real estate on the institutional side, those type of investors, a lot of times they need that cash flow. As I mentioned, they're trying to pay pensions, and so it's a really good business for that.
Yeah, and just to underline that point about American Campus Communities, they're really the only pure play, student housing publicly traded REIT. I mean, that's pretty much it, which I think is Interesting. It's one of the reasons that it's been a mogul recommendation. It's certainly something that that we've looked at for a long time.
Yeah, yeah, and they're really good at what they do too. So,
Mhm.
you have those two things, and again, you're not only getting the income here, but you're getting the growth because they can grow rental rates faster than you can do in a lot of other things. And a lot of these that we've been talking about, industrial real estate, student housing, single family homes, there's just that growth. Rents are growing really, really fast. And so you've got a stable business that performs well, surprisingly well during the pandemic, great headwind or great tailwinds, and a lot of growth. And that's what makes for a really great real estate investment.
And so the Blackstone deal that you mentioned is Blackstone's non-traded REIT, which is B REIT. We talked about that earlier. They've got a $784 million deal with Landmark Properties. They're going to acquire and recapitalize 8 student housing properties. So smaller because it's only about 5,400 beds. But if I know Blackstone, this is probably just the start of where they're going with this.
Yeah, they helped another company. I can't remember off the top of my head, but it was Educational Properties Trust. They helped take that private a couple of years ago, and they handpicked 20 student housing properties out of that portfolio, and they put it in B REIT. So this kind of adds to that. And this Landmark deal, they talked about it in the press releases that this is kind of the start of a relationship where they expect to expand that partnership. And again, it's another one of these examples of really sophisticated investors. They see a lot of opportunities here. And so for us on the other side, we can see them doing this. And it just is a signal to me, hey, look closer at American campus communities, because that's your opportunity here. That if you want to get into that space, you got a lot of smart people in this space, and that's an opportunity.
Yeah, absolutely. And one more in the student housing space, TPG Real Estate Partners, they purchased the student housing portfolio from Preferred Apartments Communities, which is ticker APTS. And that was 8 properties and over 6,000 beds. That was for 478 million last year. So lot of money trading hands in this sector, certainly a lot of potential for growth. But let's talk about, for the last portion here, single family rental home boom. You and I have talked about it before. The Trailblazers team talks about it all the time. It's the amount of money going into this space right now, and the variety of players is really interesting to me, because you consider when this sort of institutional idea of institutional single family rentals, Invitation Homes sort of started this at the start, in the middle of the great financial crisis with Blackstone, of course. Now they're the behemoth in the space with about 80,000 homes, and they're only getting bigger. But the competition that they're facing, both public and private, also is getting bigger.
Yeah, and that's why they're such an interesting company, because of their size and because they're so big. They can attract strategic investors. So two of the things that they've done this year is they formed a $375 million joint venture with Rockport Group to acquire single family homes, and so that gives them the capital to expand without really expanding their balance sheet too much. And then they did another innovative strategic relationship, this time with Pulte Group, which is a home builder, and they're going to buy 7,500 homes that Pulte is specifically building for them for rent over the next 5 years. And so here we see these two similar trends that we talked about with the equity residential, where we have a home builder partnering with a really sophisticated investor, and it gives the home builder this steady income. They know they're going to sell 7,500 homes over the next 5 years. They can plan for that. They can put that capital, instead of like going and putting all that money to risk, where they buy land and then they get it ready, and then we have the housing market collapse. They know they're going to sell these homes, so it's great for them. And then for Invitation, they don't have to go and compete against all these other companies that are getting into space. They have all these homes ready to buy. I think they're going to buy 1,000 of them over by sometime early next year. Is going to close. It's in great markets, Sunbelt market. So it's a great deal, really smart deal for them. They're one of my favorite holdings. Their rental rates are going through the roof. I believe it was like 11% rental growth rate, with just phenomenal growth. So a really exciting company.
Well, and I think this whole thing is interesting too, because you would figure if they're selling off built around a whole community, that it would be like a discount or something like that. But these are actually selling at a premium, which I find interesting. You and I both are interested in fundraising in the real estate crowdfunding. They bought a community last year from DR Horton. They've amassed more capital to get deeper into that space as well. So you see, you've got the home builders, you've got Invitation Homes, you've got real estate crowdfunding, you've got private capital. So many different streams are coming into this space that I just find it's just fascinating to see how fast this has all come together. And it's really interesting, I think, for investors to see when the market kind of as a whole catches an idea, feels like it's got a long-term thing. Similar thing that we're seeing with industrial and logistics, the ways that capital amasses and transfers really rapidly. You can kind of, it's kind of like watching like a neural network. You see these like things going ping, ping, ping all over the place.
Yeah, and that's why I love watching what other people are doing, because you can really see the underlying trend is like, oh, this is really big. This is going to be really big, and that is what we're seeing in single family homes. And a lot of it comes down to just how people are changing. Where it used to be you'd buy a house and you'd be in there 30 years, and that's just not the case anymore. I know my wife and I have bought and sold 3 homes in 10 years of marriage just because we just wanted that flexibility. And, now we live in 2 places, and you're seeing people like that with that flexibility where they're opting to rent instead of what we're doing. We bought 2 places, but a lot of times they're renting or they're Airbnb-ing. Just that flexibility that you see now with remote work, where let's say they want to live in Austin for a couple of years and then they want to live in, maybe Seattle. That's what these single family rental companies offer, is that flexibility. And that's why this trend is really picking up. And then you just have so much money flowing into it because you have these sophisticated investors that are looking for yield, they're looking for growth, and this satisfies both of those.
Well, and the other factor too is that home prices have gotten so ridiculously high that it is in many markets it is cheaper. It makes more sense to rent, even with interest rates being low. And every indication that we're seeing is that interest rates being low isn't something that's going to last forever. And when they do go up, we're going to see a lot of sticker shock. And keying in onto that idea of remote work, one of the things that I've been watching on the startup side is you've got people moving around. They want that mobility, but they also want equity. So I'm seeing just the start of very small companies that are buying homes and renting them out where people get an equity share or they contribute equity, sort of like an iteration of like a rent to own model. Not any really investable ideas there yet, but something that I think is interesting because we're seeing something happen where people want that mobility. They like the single family rental, but then they also have that worry about, are they also, throwing their money away?
Yeah, and we hadn't really talked about this deal, but Blackstone, they're buying this Home Partners of America for $6 billion. They own 17,000 homes, and one of their business model is to really work with people that want to rent a home, and they'll go out and they'll buy a home that meets their criteria, but is a place that the home buyer would consider buying in the future, and they'll have that option to buy. So it's a different spin on this, and it's definitely a model that's out there for people that maybe you don't have that down payment right now, or you're not sure if this is the right location. Being in a place that you could see yourself in, kind of that rent to own model, I can see more of that happening too.
Yeah, one of the reasons I love talking about real estate and real estate technology is because I think, and you and the Trailblazers team are working on this, we're just seeing so many new ideas that are taking traditional real estate and packaging it in new ways, speeding up the transaction, changing down payments, basically changing everything. And so the single family rental boom is definitely part of that. Just wanted to mention one more deal that we had on our list here, which was Lennar and their $4 billion single family rental platform that they're working on. I mean, Lennar, they're the giants in home building. And so they're definitely focused on townhomes, standalone homes in high growth markets. That could be an interesting competitor to Invitation Homes. And there's also so many other small players that are starting to emerge in the single family rental space as well.
Yeah, and it's interesting to see these home builders getting into that, because they're really like Invitation Homes, their business model was to go find an existing home that they could rent out, and you had to get a newer existing home because homes they deteriorate pretty fast, and so that maintenance. But if you're buying these new homes, and I just bought it, I bought two new homes in my life, and they're great because you don't have that maintenance. I own an older townhome and it's got a lot of maintenance, so that's been a deterrent to some of these. But when you're buying them directly from the builder and you can buy a home that's built specifically for renters in mind, it marries these two ideas very well. And I think Lennar getting into the game is, a really big thing for them because it provides that stability. They can sell a steady stream home to this platform, and it'll really make this platform a good one for the investors because visible growth and just the right type of homes for that type of market.
Well, another factor too, and I think this is one of the reasons that it's easier to manage single family homes at this point, is the impact of smart home technology. I know Invitation Homes is looking at putting smart home packages in a lot of their homes. Lennar does that in a lot of their new builds. And so you've got this ability to monitor individual homes in a way that you wouldn't have had. It just didn't exist, a decade ago. And I think that's part of it too, is that you've really got a way to take the data and make it sort of actionable in a way that you could previously only do in a multifamily when you could kind of see everything in one building. Now, using data, you can kind of remote monitor. There's a lot more that can be done. I feel like we're just at the beginning of smart homes. I think that people tend to focus on the ideas of like turning on the lights automatically, but the more fascinating stuff is, temperature, plumbing drips, things, little maintenance issues, and catching them before they get bigger.
Yeah, well, and as somebody that owns homes that I'm 10 hours away from one of my houses. I have a place in Charleston and then one in Pittsburgh, and I can remotely watch the house that I'm not there. With my Ring cameras, I can check in and make sure that everything looks okay. I've had Nest learning thermostats before to check the temperatures. So it really helps people that, your snowbirds that want to do that type of thing, or your remote workers that maybe they'll have a vacation home somewhere else. So it really enhances that. I don't have to worry about it. And there's even things like I've realized in the couple of months that I've been away from my house is that I really should have installed some sort of remote locking system on the door, because I had UPS or somebody like that drop off packages to the wrong address, and I had to have somebody go over with a key. So it's things like that where this technology makes those type of things easier. I don't have to give somebody a key. I can just give them a code. And so I'm really excited, just as somebody that's in this, of what new technology is out there that'll make my life easier.
Right. And then you start looking at companies like Latch or companies like Smart Rent that are in that business as well. Those are companies that we've talked about as investments as well. You've really got a lot of investable ideas starting to all come together around this single family rental boom.
Yeah. And then you throw in being able to use vacation rentals for these places, and it just opens the door to so many people can really be real estate investors that couldn't before. Being a vacation home owner is something that was a very tough process before, but now Airbnb makes that easy. And so there's just so many new opportunities that we're seeing just through technology.
Absolutely. All right. We've got about 3 minutes. So let's wrap up the impact of all of these deals and what we're going to see going forward. I wanted to bring up one stat, sort of real estate related, that I saw in the Wall Street Journal today, that said in the first 8 months of 2021, companies announced mergers and acquisitions worth more than 1.8 trillion in the US and more than 3.6 trillion globally. So really, it's not just happening in real estate, it's happening everywhere. There's mergers, acquisitions, joint ventures. There's so much capital. And we talked at the beginning about this, that capital is impatient. We saw a lot of dry powder amassing at the beginning of the the pandemic. But you know what I mean? Like that idea of like, okay, there's an opportunity. We're going to spend this money. That opportunity that they thought was going to come didn't come. And now we're seeing, some strategic moves, but also some people seem to maybe be paying a lot for things that, it's interesting. do you have any concerns that some companies are paying too much for things?
Yeah, absolutely. Because real estate is very cyclical. So eventually this is going to come home to roost and we will see this. But there's just so much demand out there for single family rentals, for industrial properties, that we're probably years away before that'll come. And there's probably a lot more froth before then, because we just went through the down cycle. We're just recovering from that down cycle. So I would be surprised if we have another down cycle soon. But interest rates is going to play a key role. How quickly is the Fed going to raise interest rates? And if they raise them, really fast because inflation gets hot, that could be what triggers, some of this where we have a cool off. But I don't see them doing that because, for example, the Delta variant came out of nowhere, slowed everything down really quickly, did what a federal interest rate reduction would have done. So I think it tapped the brakes. We could have another one. Hopefully we don't, but it's just one of those risks that's out there. So I really think that we're in for a couple more years of boom. That's where I'm investing, and that's where I'm what I'm seeing.
Yeah, I would agree. One last note on that too is you mentioned the Delta variant. I thought it was interesting to see that it hasn't really seemed to scuttle any deals yet. At the beginning of the pandemic, we saw a lot of deals get paused or something like that. So far, it doesn't seem to be doing anything in terms of really kind of the feeling of continued optimism.
Yeah, I think we have decided we are going to live with this virus. Maybe that's not the best solution, but that's just what everybody has decided, that we're ready to move on and live with it. Now, we have companies that aren't back in the office yet. I'm really surprised because, I saw packed football stadiums over the weekend. That was all through Twitter. So if we're willing to go, football games, why aren't we willing to go back to the office yet? That's the one thing that I'm waiting to see, and that'll show me that we're really back. But I think we're ready to move on. We're ready to live with this.
All right. Well, that brings us to the end of the hour. Matt, thanks so much for your time today.
Thanks for having me.